All right. It is 2:02 and we should start. All right. So good afternoon, everyone, and welcome to today's webinar titled The New Nigerian Tax Regime, What Non-Residents Need to Know. So my name is Emma Ndiyo. I am a senior associate in the Dispute Resolution and Tax Department at Aluko and Oyebode, and I will be moderating this session. As you may already know, the President of the Federal Republic of Nigeria, President Bola Ahmed Tinubu, signed 4 significant tax bills into law on 26th of June 2025. The Nigerian Tax Act, the Nigerian Tax Administration Act, the Joint Revenue Board of Nigeria Establishment Act, and the Nigerian Revenue Service Establishment Act. Together, these acts of the National Assembly have consolidated Nigeria's legal framework on taxation, repealed several provisions, and introduced wide-ranging reforms. By and large, the new laws are expected to transform tax administration, expand the tax base, and align Nigeria's fiscal regime with global standards. Over the next 90 minutes or so, we'll explore how these changes affect non-resident entities doing business or deriving income from Nigeria. We'll cover legislative reforms, compliance obligations, international tax trends, and treaty implications of these reforms. To do this, we would have a panel session and then afterwards Q&A session. So please feel free to post your questions in the Q&A function of this application that we are using for the session. And I will just very quickly go ahead to introduce to you the panelists. To unpack the conversation, we have 5 distinguished panel of speakers, 2 of whom are from in-house here in Aluko and Oyebode, the head of our tax team, Mr. Chukwuka Ikwuazom, Senior Advocate of Nigeria. He is a Senior Advocate of Nigeria and an accomplished tax litigator. He advises both Nigerian and multinational clients on contentious and transactional tax matters. I also have here with us Mr. Agbada Agbada, who is also a senior associate in the tax practice of Aluko and Oyebode, and a skilled and passionate tax practitioner. I also have from the Federal Inland Revenue Service 2 distinguished officials of the FIRS, Dr. Simeon Obidairo, who before joining the FIRS was a partner here in Aluko and Oyebode, but he's now a coordinating director and chief counsel at the FIRS, where he oversees compliance and enforcement, including audits, litigation, and debt recovery. Dr. Obidairo is deeply involved in implementing the recent tax reforms. We also have with us Ms. Hauwa Dili from the Competent Authority Department of Affairs. She has over a decade experience in tax policy, legal drafting, non-interest finance as well. And she has also played a key role in the ongoing efforts to shape Nigeria's tax reform agenda. Last, but certainly not the least, we have with us Mr. Taiwo Oyedele, the chairman of the Presidential Fiscal Policy and Tax Reform Committee. It is impossible for us to discuss the tax reform of 2025 without mentioning Mr. Oyedele, as he was at the forefront of this reform, which is by far Nigeria's most ambitious fiscal reform agenda to date. Mr. Oyedele was appointed chairman of the Presidential Fiscal Policy and Tax Reform Committee following an impactful career as Africa tax leader at PricewaterhouseCoopers, PwC. He is also an educator, thought leader, and development advocate, passionate about building capacity through policy and education. To begin our conversation today, I will like to commence with none other than Mr. Oyedele, the man who led the reform, to share with us his thoughts on the policy rationale behind the reforms. Mr. Oyedele, could you broadly speak to what the key drivers for the reform to the statutory framework is as touching taxing non-resident persons in Nigeria?
All right, thank you and good afternoon to everyone. Thank you for inviting me. Broadly speaking, with respect to the taxation of non-resident persons, we have three core objectives. One is to provide a level playing field. In other words, you shouldn't have an advantage, neither should you be disadvantaged by doing your business in Nigeria as a non-resident entity or person compared to a Nigerian business. Of course, if we intentionally confer advantages on Nigerian businesses, such as the 0% for small businesses, that will be intentional by policy. Otherwise, we want to create a level playing field, particularly for digital, for operators within the digital economy, where you can be anywhere in the world and then you're doing business with Nigeria. So number one objective is a level playing field for all taxpayers. Number two is to protect our tax base in the sense that, for example, when it comes to issues around base erosion and profit shifting, multinationals have the advantage to be able to move profit around. If you're just a Nigerian business with no operation elsewhere in the world, you can't move your profit anywhere. So you're within our jurisdiction. So what we've also done now is to strengthen the framework to ensure that we're able to protect our tax base, including, for example, the top-up minimum tax of 15%. The third and final most important reason for this is modernization. Because we know that the world is moving and we can't stay in one place. In fact, the world is moving at such a very fast pace that you have to be running just to stand still. So when it comes to things around virtual currency, strengthening significant economic presence, threshold for permanent establishment, and even who is a Nigerian company, which you need to establish first before you can determine who is a non-Nigerian company or non-resident. So those rules are now, very different from what they used to be before. And we have a number of anti-avoidance provisions, such as the control foreign corporation that we have introduced. And some of these is really just to ensure, like I said, broadly, level playing field, protect our tax base, and then modernize the tax system. Thank you.
Thank you so much, Mr. Oyedele, for that insightful contribution. Now, I'll go to Mr. Chukwuka Ikwuazom, SAN. Mr. Chukwuka Ikwuazom, could you please walk us through the major changes to the legal framework to taxing non-residents in Nigeria?
Thank you very much, Emma. And welcome everybody to this webinar. What I'm going to try to do in answering your question is to first, give a summary of the changes that the new regime of tax for non-resident companies, non-resident persons has introduced. And then if I have time, because I'm mindful of the fact that I have just 10 minutes, if I have time, I will highlight what I consider to be the most important differences. So the starting point is to say that under the new regime introduced by the new tax acts, non-resident persons are liable to pay tax on the gains that they make from Nigeria and the profit/income that they derive. Of course, the difference between gains and business profits used to be something very big, but one of the important changes introduced by the new tax acts is the alignment of the rate of companies' income tax and the rate of capital gains tax. But non-resident companies that derive gains from a disposal of chargeable assets in Nigeria are liable to pay tax if one of three conditions is satisfied. One is if the gains relate to any trade, business, profession, or vocation that the non-resident company carries on in Nigeria. The second is where the gains relate to any asset that is located in Nigeria. And the third is where the gains relate to any deemed asset, any asset that is deemed to be located in Nigeria. And my colleague Agbada is going to speak on the concept of deemed location of assets in Nigeria, which is one of the changes made by the new tax act. Now, as it concerns business profits, the profits that a non-resident company accrue in or derive from Nigeria will be liable to tax in Nigeria, again, if one of three conditions is satisfied. The first is where the non-resident person has a permanent establishment or a significant economic presence in Nigeria, and the profits in question are attributable to that PE or SAP. So that's the first condition. The second condition is where a payment is made to a non-resident person by a resident person in Nigeria or the permanent establishment of a non-resident person in respect of any services that the non-resident company has provided from outside of Nigeria. Now, the Nigerian Tax Act makes three exceptions to this. So the first exception is where payment is made to an employee of the person making the payment under a contract of employment. In that kind of situation, that payment will not be liable to tax. The second one is when a payment is made by an individual or an educational institution for teaching in an educational institution. So that's the second exception to liability of tax as a result of a payment made for services. And the third is where the payment in question is made by a foreign permanent establishment of a Nigerian resident, and that expense is borne by that foreign permanent establishment. So I have mentioned two conditions. The first is where there's a PE or SEP. The second is where payment is made for services provided outside of Nigeria. The third is payments that relate to insurance premiums when they are made by a Nigerian resident or a permanent establishment of a non-resident company to a non-resident company. Now, it's important to make the point that the Nigerian Tax Act says that withholding tax that is deducted for payment for services and payment for insurance premiums will be the final tax for a non-resident company. Now, I think it's important that I make the point that the Nigerian Tax Act has introduced certain conditions that apply to the ascertainment of the profits that a non-resident company is deemed to derive from Nigeria. So the first is that a permanent establishment will be deemed to have the same credit rating as the non-resident company that it is a permanent establishment of. So this is particularly relevant in the context of related party funding, where it is no longer possible to increase interest as a result of the credit risks that may be ascribed to a permanent establishment. And this is essentially because the law says that you have to assign the same credit rating to the permanent establishment that its foreign parent has. The second condition is that a permanent establishment will be deemed to have the same equity and loan capital as it is reasonable to ascribe to it by the relevant tax authority. Now, the third condition is what I will call the force of attraction rule. So what this essentially says is that if a non-resident company has a permanent establishment in Nigeria and the non-resident company sells goods or merchandise directly into the Nigerian market that is of the same or a similar kind as the goods and merchandise that it would sell through the permanent establishment that it has in Nigeria, then in ascertaining the profits of the permanent establishment, you have to take into account the profits that the non-resident company has derived from such direct sale of goods and merchandise into Nigeria. So the same thing applies to services, where a non-resident company provides services directly into Nigeria, but the services are of the same or similar kind as the services that the non-resident company will provide through the permanent establishment. Then in ascertaining the profits of the permanent establishment, profits that the non-resident company made by the direct provision of those services will be taken into account. The next condition, just keep in mind that I'm addressing the conditions that have been introduced for the purposes of ascertaining the taxable profits of a permanent establishment. And the next one relates to cost deduction. So it's now been made clear that only costs incurred for and in the production of the profits attributable to a permanent establishment will be deducted. It follows, therefore, that costs in form of payments made by a permanent establishment to its foreign parent for the use of patents and other like fees will not be deductible unless those relate to just reimbursement of expenses. So what this means in essence is that if a permanent establishment makes a payment to its foreign parent for the use of a patent or any such rights, then the permanent establishment will not be able to deduct that cost, unless it is just a reimbursement of the actual expense incurred by the foreign parent in providing the patent. Now, one of the most important changes that the new tax acts have introduced to the taxation of non-resident companies will relate to the so-called minimum tax. So the new regime provides that where it is not possible to otherwise ascertain the taxable profits of a non-resident company, then the way to ascertain the profits will be to apply the non-resident company's profit margin to the total revenue derived from Nigeria. And the profit margin is defined as a proportion of the non-resident's revenue, right? As a proportion of the non-resident's earnings before interest and tax to its total revenue. So if it is not possible to otherwise ascertain the profits that a non-resident company has derived from Nigeria, the relevant tax authority will do so by using the non-resident profit margin and applying it to the total revenue generated by the non-resident company from Nigeria. Now, even where it is possible to ascertain the taxable profits of a non-resident company, if those taxable profits are less than the amount that will result from applying the profit margin, then that amount that will result from applying the profit margin will be taken to be the taxable profits of the non-resident company for Nigerian tax purposes. And then there's a provision in the NTA that says that the minimum tax that a non-resident company can pay in Nigeria will be the amount that is liable to be deducted by way of withholding tax under Section 51 of the Nigerian Tax Administration Act. But if the payment in question is not liable to withholding under that act, then it will be 4% of the total revenue derived by the non-resident company from Nigeria. So it's important to keep in mind that there is a minimum tax of 4%. That's the minimum tax that a non-resident company can pay, 4% of the total amount that the non-resident company has derived from Nigeria. Now, I will go on to just briefly talk about what I consider to be the major differences. So under the current regime, I say the current regime because the regime that we have in force now will continue in force until 1st of January 2026, when the new regime will come into place. Under the current regime, the profits derived by a non-resident company from Nigeria will be liable to tax in Nigeria, where that non-resident company is deemed to have a fixed base of business in Nigeria. Now, you will note from what I have said up to this point that the new tax regime does not adopt the concept of a fixed base of business. It has adopted the concept of a permanent establishment. Now, why do I think that that may be significant? Nigerian courts have defined a fixed base of business as a place that has some permanence, a place that is available for a non-resident company to carry out its business, but with a certain degree of permanence. Now, in the new regime, nothing is said about a fixed base of business. A permanent establishment is simply defined to include, among other things, a place of business. So what this means is that that criterion or that condition that a place of business will have some level of permanence may no longer be relevant in determining the tax liability of a non-resident company. The second point to note is that under the current regime, a non-resident company will be liable to pay tax where it habitually operates a trade or business through a person that is authorized to conclude to conduct that business on its behalf. Again, the definition of permanent establishment under the new regime does not deploy the word habitually. So what that means is that unlike under the current regime where you have to demonstrate that the business has been going on for some time at that location, there may not be any need for that under the current regime. Again, under the current regime, a non-resident company will be liable to tax if it habitually maintains a stock of goods or merchandise from which regular supplies are made on behalf of the non-resident company. Again, in the definition of permanent establishment under the new regime, the words habitually and regularly have been dropped. So again, you don't have to show that a non-resident company that maintains a stock of goods or merchandise in Nigeria does so habitually, and that supplies are made on a regular basis. Also, under the current regime, one of the conditions under which the profits of a non-resident company may be taxed is where that non-resident company gets involved in a single contract for surveys, deliveries, installations, and construction. And, because of this provision, one of the most common tax planning schemes, that we see under the current regime is where a non-resident company is entering into a turnkey contract, but the contract is split, so that a portion of it is undertaken in Nigeria and a portion is undertaken outside Nigeria. And I remember that a few years ago, our firm was involved in a matter involving Japan Gas Company and the FIRS, where the Federal High Court held that where you have a split contract like that, and part of the contract is executed wholly outside Nigeria, then the profits from that portion of the contract will not be liable to tax in Nigeria. Now, it's important to note that under the current regime, a permanent establishment is defined in such a way that where a non-resident company, engages in a contract for surveys, delivery, installation, building, construction, even if it is a split, and regardless of the number of entities, that are involved in the execution of the contract, under the new regime, the totality of the income will be liable to tax. So I'll stop here because I think I've exceeded my time. Thank you.
Thank you so much, Mr. Ikwuazom. I would like to mention before I go on to the next panelist that if you have any questions, please put it in the Q&A feature of the Zoom app, and we'll address them when we come to the end of the panel session. So I'll go now to you, Mr. Agbada. So a novel provision has been introduced in relation to capital gains tax on indirect disposal of shares. In simple terms, what does this provision mean, and what does it seek to achieve?
Okay, thank you very much, Emma. As you rightly mentioned, this is a novel provision. And what it means in simple terms is that gains derived by a non-resident person from a disposal of shares in a non-resident entity will be chargeable in Nigeria if that transaction results in a change in ownership or ownership structure or group membership of a Nigerian company, or it results in a change in title or ownership of an asset located in Nigeria. And this is significantly different from the current capital gains tax system, under which only gains derived from a disposal of shares in a Nigerian company will be chargeable. And I think that an important point to make at this point is that under the current regime, capital gains tax obligations will be triggered typically under two situations. One is where the recipient of the gain is resident in Nigeria, so a Nigerian resident. In that case, it would not matter if the asset is located onshore, offshore. And this is because the global income of that individual or entity that is receiving the gains will be chargeable in Nigeria. And of course, this is consistent with the residence basis of taxation. The second situation where capital gains tax obligation will arise is where the asset that is being disposed of is located in Nigeria. And where that is the case, it would not matter if the recipient is non-resident or resident, because in that instance, the income will be sourced from Nigeria. And again, this is consistent with the source basis of taxation. But the NTA has now provided a broader basis for taxing gains derived by non-resident persons from disposal of shares. It does this by introducing the concept of deemed location of shares that Mr. Ikwuazom talked about. And under the NTA, shares will be deemed to be shares in a non-resident entity will be deemed to be located in Nigeria if any time within the 365 days preceding the disposal of the shares, more than 50% of the value of the shares was attributable or is attributable to a Nigerian company or an asset located in Nigeria. And where this value threshold is met within the 365 days preceding the alienation, the transaction disposing those shares, transferring or disposing of those shares will be chargeable in Nigeria. Now, what does this new provision seek to achieve? One is to protect Nigeria's tax base, expand Nigeria's tax net to cover offshore transactions that would have otherwise escaped taxation in the country. And secondly, it also seeks to reasonably align Nigeria's domestic capital gains tax regime with what is obtainable under some of our double taxation agreements, especially the more recent double taxation agreements that the country has entered into. Those agreements make provision for similar rules for taxing indirect transfers of assets in Nigeria by residents of the treaty partners. And of course, finally, it would also counteract or address the use of offshore holding structures to avoid capital gains tax payment in Nigeria by non-resident entities. Thank you very much.
Thank you so much, Mr. Agbada, for that. Next, we'll be hearing from the regulators. We have two of them from the FIRS, Dr. Simeon Obidairo and Ms. Hauwa Dili. They will both be addressing the next question, which is, will there be additional compliance requirements and obligations for non-residents under the new law? And what are the implications of non-compliance? I'll address this to Dr. Obidairo to commence. Thank you.
Emma, thank you very, very much. And thank you to Aluko and Oyebode for inviting the FIRS to this session. Just to put things in context, I think that there have been two major tax overhauls in the last 50 years that have been of major significance. South Korea in the 60s and the US in 2018. Just to give you some context, the South Korean experience had about 65 line item amendments to the existing tax regulation. We've counted about 560 amendments or changes to the tax regime in Nigeria. Not all of them, of course, are affecting non-residents, but a significant number of them doing so. So with specific reference to non-residents, I think I will ask my colleague, Hauwa, to go through some of the new compliance obligations that the various tax laws have elaborated for non-residents. And then at the end, I'll just come in and talk about some of the implications of non-compliance. So Hauwa, maybe you can take us through some of the changes.
Thank you very much, sir. Good afternoon, ladies and gentlemen. Thank you for joining us this afternoon. Going by the discussion so far, we can all agree and we all know that non-resident persons are liable to tax on profits or income derived from Nigeria. Now, the Nigerian Tax Act and Nigerian Tax Administration Act stipulate the tax liability, the exemptions, returns, and compliance requirements for these persons. I will be highlighting some of the compliance obligations for you this afternoon. The first compliance obligation that you should take note of is registration. Section 6 of the Nigerian Tax Administration Act, which I like to call the NTAD, states that a non-resident person shall register for tax purposes in Nigeria where that non-resident person supplies goods or services or derives income from Nigeria. However, where the non-resident person derives only passive income, like dividends and the rest, registration may not be required, but relevant information shall be provided as prescribed by the service. Now, it should be noted that only the Nigerian Revenue Service has jurisdiction on non-resident taxation in Nigeria. Upon registration, a tax ID will be issued to the non-resident person by the service, and that tax ID shall not be transferable or usable by another taxable person or another non-resident person. I'm sure some of us will be wondering whether the tax ID is different from the TIN number. Now, the tax ID is a nomenclature used to describe the number to be used for tax identification purposes. And since the Nigerian Tax Administration Act, the NTAD, applies to all the tax authorities, this number can be the current TIN number that we have, it can be the NIN or any other number as may be determined by the tax authorities. So where this tax ID is issued to a non-resident person, it shall be used for tax compliance purposes. For example, it can be stated on a return. It can be used in a correspondence with the service. Now, we should note that under the new Tax Administration Act, a tax ID can be suspended, it can be deregistered, or it can be cancelled by the service. It is all the provisions are stipulated under Section 10 of the Nigerian Tax Administration Act. Where a taxable person fails to register, the person shall be liable to pay an administrative penalty of 50,000 naira in the first month and 25,000 naira for each subsequent month. Going to the next compliance obligation is the returns. Now, under the Nigerian Tax Administration Act, all provisions relating to the returns are now contained in a single chapter. So all returns that were contained in the Companies Income Tax Act or any other act have been harmonized under a single chapter. Specifically, Section 11 and 12 provides for returns of income tax of companies and individuals. So every taxable person, whether or not such person is exempted from incorporation or registration, shall file a self-assessment return for a year of assessment. Now, Section 11, 2, and 3 provides the contents of returns to be filed by non-resident companies. And it also states its non-applicability of the section on an income that has suffered deduction at source. Under the same chapter, Section 14 goes on to stipulate the pay-as-you-earn returns. This is applicable to non-resident employers in respect of their employees. Now, failure to file returns is provided under Section 101, and where a person is found liable, they shall pay a penalty of 100,000 naira in the first month or 50,000 for each subsequent month. In some types of businesses where non-residents are engaged in specialized businesses like shipping and airline, mining operations, or virtual asset service provision, there are additional returns to be filed together with the returns contained under Section 11. Also, a non-resident company that is enjoying incentives or is enjoying an incentive under the priority sector, which we used to know as the pioneer status. Now it's known as the economic development tax incentive. Where a non-resident is enjoying such an incentive, the non-resident has to file tax incentive returns. This returns is also contained under the chapter 2, which has returns. There's a new tax obligation that was introduced under the Nigerian Tax Act, and that is the disclosure of tax planning. Now, a non-resident person who engages in or intend to engage in any transaction, agreement, scheme, or transaction that would result in obtaining a tax advantage must proactively disclose that transaction to the service, even without being asked. Now, this disclosure is a mandatory disclosure. It is not optional, and the service shouldn't have to ask. Now, the provision further states that the service shall issue regulations for specific informations and process of reporting. It shall also state the penalties, if any, for non-disclosure, for false disclosure, and incomplete disclosure. Now, this provision is not alien to tax law. It is an anti-BEPS provision to combat tax avoidance and offshore opacity. Most European laws have it, and in Africa, South Africa has also has it. They also administer the provision. Now, still on the returns, we have the obligation of books of account, where non-resident companies shall also maintain books of account containing sufficient information for relevant transactions. It is under Section 31 of the Nigerian Tax Administration Act. Non-residents are also to file their income tax assessment in the currency of transaction, which is also under the Nigerian Tax Administration Act. The next compliance I'll be talking about is the payment of tax. Now, this is a very, very important obligation where a non-resident person should make payment of tax on or before the due dates of filing in lump sum or installments. Dr. Obidairo will talk about the implications of non-payment or late payment of tax. Now, the next obligation is deduction at source, where a non-resident deriving income from Nigeria has the obligation to deduct tax at the rate prescribed in the withholding tax regulation. He should, or the person should do so. The latest version of the withholding tax regulation is the one that was signed in 2024, but I'm sure that there will be updates to it to reflect any new changes. Now, last but not the least, the VAT compliance on non-resident earning commission. Section 151 sub 5 of the Nigerian Tax Act, now I have moved to the Nigerian Tax Act, states that where a non-resident appointed as an agent by the service earns commission relating to taxable supplies to Nigeria, the non-resident person must charge, the non-resident must collect, and then remit that VAT that was collected on their commission. Now, they will collect that VAT using the same system or process through which they received the commission. So just to break it down for you, the compliance obligations here are, for example, a company abroad has been appointed as a tax agent, and that company facilitates a trade where supply of laptops, let's say, were made to Nigeria, let's say from Ghana or from the UAE, and he earns a commission. Now, that company shall charge VAT on that commission at the rate of 7.5%. The rate of VAT has not changed, it's still 7.5%. And that company shall collect the VAT through the same means it collected its commission, and then shall remit the VAT to the service. That company shall also keep proper records and make appropriate returns in line with Section 151 sub 5 of the Nigerian Tax Act. There are consequences for non-compliance, which can include failure to collect that tax. The penalties under Chapter 4 would apply. Failure to remit that tax when collected, failure to keep proper books, and even failure to register in some cases. So it is important for us to note these compliance obligations and comply with them to avoid getting liable for penalties and the rest. So thank you so much. Back to you, Dr. Obidairo.
Okay, no, thank you, Hauwa, for that. I think I'll just quickly we run out of time, so I'll just quickly run through some of what I think the highlights of changes to the compliance and enforcement portions of the Act. I think the major one is that there is now a new regime for calculating the rates and interest for late payment of taxes. Prior to the passage of the Act, the rates used was, I think, LIBOR, and the rates differed across various portions of the Act. But right now, it's going to be the secured overnight financing rate plus 10% and a penalty. More interestingly, interest is no longer calculated on a simple basis. It will be on a compound basis. And this provision will apply to all debts that remain outstanding from the date the legislation comes into force. So that's one major change. The second is that prior to filing an action at the Federal High Court, taxpayers are obliged to deposit 20% of the disputed sum in the court before they are eligible to file an appeal. So this is an appeal from the Tax Appeal Tribunal. The Act has allowed the new NRS to engage debt recovery partners, both locally and internationally, to assist with recovering debts that the NRS is unable to recover. The fourth change to the compliance regime is there's been an enhancement to the powers of substitution. So the powers of substitutions of the NRS are that if a taxpayer owes money and any other party who is either holding the funds or the assets of the indebted taxpayer may be substituted for that taxpayer and required to hand over such funds or assets to the NRS. This provision has always existed, but the revisions to the Act mean that those provisions can be enforced by the NRS without a court order. There are broad changes to the administrative penalties regime. Also, there are provisions to, if you're in the oil and gas industry, to make provisions for the revocation of licenses if debts are owed by oil companies. There's also been there's also the FRS has had previously had a settlement process which was not codified. The Act has now codified that process. So there's an elaborate process by which settlements may be reached on disputed assets. Last point I will make is there's a whole new elaborate regime on how virtual assets will be treated and enforced, and the FRS or NRS will play a significant role in that process. I think I will stop here and we'll elaborate if there are any other questions.
All right, thank you so much. Thank you so much, Dr. Obidairo and Ms. Dili, for giving us the regulator's perspective to this. You've spoken to us regarding the registration requirement, the tax ID, self-assessment, and of course, VAT compliance, deduction at source, and now the compliance issues, in effect, that's non-compliance issues. So now we go back to you, Mr. Oyedele, with the US challenge to Pillar 2 of the OECD's solution and the ongoing global uncertainty. Do you foresee Nigeria proceeding with the implementation of the minimum tax under the NTA? And what would the impact be on the foreign direct investment in Nigeria?
All right, thank you very much. So first and foremost, we are doing our reforms for Nigeria. So the interest of the country is first and foremost. While the US has its own interest to protect, which we fully respect, we also believe that we should not be doing our reforms for any other country. And you also have to bear in mind that the current administration in the US has very different stance on a number of issues, including the OECD action plans, and particularly Pillar 1, Pillar 2, but these regimes are for a while, so 3.5 years, whereas our reforms are long-term focused. That's the first point to me. The second point is when it comes to Pillar 2 specifically, it does not require countries to agree. There has been a framework that has been developed, and currently over 70 countries have introduced legislations one way or the other to try and protect their own base, because essentially if you allow your base to be eroded, another country benefits. So we've just done the rational thing to do is what Nigeria has done. And like I said, we're not the only country that has done anything similar to this. In fact, many countries have done this before us. Many more countries will do it after us. And the third point is this is not targeted at any particular country. So we're not targeting the US, we're not targeting any other country for that matter. We're just doing this for ourselves. And in fact, if you look at the way the rules have been written, and there are instances where even Nigerian companies will have to do this top-up tax. So we do not think that there will be any justifiable reason for the US or any other country for that matter to interpret what we have done as being designed to target their companies and therefore wanting to take any action. So for us, we're pressing forward with the reforms and full implementations of all the provisions, including the top-up tax, which is seeking to address Pillar 2.
All right. Thank you so much, Mr. Oyedele, for your intervention. I'll just like to reiterate that if you have any questions, please indicate your questions in the Q&A feature, and we'll address them as soon as the panel session is over. I'll go back to you now, Mr. Agbada. What are the practical implications of the new rules on indirect transfers, particularly regarding the portion of gains that may be taxable in Nigeria?
Emma, there would obviously be significant implications for non-residents who hold shares in Nigerian company with the implementation of these provisions. With regard to the portion of the gains that will be taxable in Nigeria, I must say that the law does not provide for apportionment rules, rules that you can rely on in determining the portion of the gain that should be taxable in Nigeria. But an argument can be made, a very good argument can be made, that only the portion of the gains that's attributable to Nigeria should be chargeable in Nigeria. So for example, if 51% of the value of the shares being disposed of in the non-resident entity is attributable to Nigeria and 49% to some other jurisdiction. There is good basis to argue that Nigeria should be taxing only 51% of the gains derived from that disposal. And this argument can be supported by the fact that even under the general framework on taxation of non-resident persons in Nigeria, only income attributable to a permanent establishment in Nigeria, which is, of course, it's the portion of the income attributable to Nigeria, will be chargeable. But I also recognize that there is a possible alternative argument which the taxman may make, and that is the fact that because the gains, rather, the asset, right, from which the gains arise is deemed to be located in Nigeria, the entire gains from the disposal should be taxable in Nigeria. But whichever interpretation one decides to adopt, whichever interpretation that eventually the courts agree with, there is still the risk of double taxation on non-residents, because the country in which the non-resident entity whose shares are being transferred is resident, or where the shares are registered, is likely to also tax the gains arising from the transaction. That is, if that's a country that has a capital gains tax regime. But where the person, the recipient of the gains, is also resident in another country, then we have a situation where those gains may be taxable in multiple jurisdictions, right? And while I note that in treaty situations, if of course there is a double taxation agreement between Nigeria and the country of residence of the recipient, those provisions should apply to provide relief for the non-resident recipient. In other cases, non-residents are likely to suffer double or even multiple taxations, right, with the implementation of these provisions. Of course, there is also compliance obligation that would naturally, come with the implementation of these provisions. So yeah, so these are some of the practical implications that I see that non-residents would have to be mindful of.
All right, thank you so much, Agbada. Now, would to close out the main panel session, invite Mr. Ikwuazom again. Under the present tax regime, there is a clear provision indicating the supremacy of double taxation treaties over local provisions, as for instance in Section 38 of the PITA and Section 45 of the CETA. Similar provisions are, however, absent in the new tax laws. So now, Mr. Ikwuazom, how do you foresee the impact of the changes introduced by the reform on the tax treatment of non-residents in light of the absence of a DTT supremacy provision?
Thank you very much. So as you rightly noted, I think that concerns have been raised by some non-resident persons for the reason that you gave, namely that the provisions in the Companies Income Tax Act and in the PITA that expressly say that if there's a conflict between treaty provisions and the provisions of domestic laws, that the treaty provisions will prevail. Those provisions have been taken away in the new tax legislation, and that has raised the concern as to what, if any, will be the impact of the new provisions on treaty provisions. But my view is that so if you go back to the Constitution of the Federal Republic of Nigeria, I think it's Section 12, that says that when Nigeria enters into a treaty, there's a requirement for domestication, and that once a treaty has been domesticated, it will have the force of law in Nigeria. And when you go back to case law, including, I think, Fawemi and Abacha, where the Supreme Court stated that Nigeria cannot resile from its treaty obligations in circumstances where, a treaty has been domesticated. So my view is that, notwithstanding the fact that those express provisions that, upheld or uphold the supremacy of treaty provisions over domestic tax laws, notwithstanding that they've been removed, my view is that non-resident entities that are tax resident in countries that are treaty partners with Nigeria, their tax liability in Nigeria will continue to be determined in accordance with the treaty provisions. That's my view.
All right. Thank you so much, Mr. Ikwuazom, for your intervention. And thank you so much to all our panelists. It's been a very fruitful session. Now we'll be going on to Q&A. We have some questions already in the Q&A feature, and we'll be addressing them. So please, if you have further questions, now is a good time for you to include them in the Q&A session. I will still remain with you, Mr. Ikwuazom. There is a question here dealing with fixed base. So the person has asked, please, can you throw more light on the difference between company with fixed base in Nigeria as contained in Section 13 of the CETA and the permanent establishment as contained in the new regime?
Okay, so so I think the point I was trying to make, essentially is that under the current regime, and that's Section 13(2) of the Companies Income Tax Act, the criteria for subjecting the profits made by a non-resident company to tax in Nigeria are clearly set out. Those criteria include that the non-resident company has a fixed base of business. Now, there are certain decisions of Nigerian courts that have interpreted that provision to mean that the place that's available to a non-resident company for its business will be a place with some level of permanence attached to it, right? And that's because of the deployment of the phrase fixed base of business. Now, if you look at the new regime, I think Section 17 of the NTA that defines the permanent establishment, one of the things that will constitute a permanent establishment is a place of business that's available to a non-resident company for carrying out its business. Now, it doesn't say that that place has to be fixed. And I'm saying that it is not unlikely that a Nigerian court is going to interpret that to mean that, that requirement of some level of permanence will no longer be relevant in determining whether or not what a non-resident company has in Nigeria constitutes a permanent establishment. So that's the point I was trying to make. Beyond just a fixed base of business, and under the current regime, a non-resident company will also be liable to tax in Nigeria where it habitually carries out a trade or business through a person that is authorized to conduct that business on its behalf or on behalf of a related company, right? the use of the word habitually will also suggest that this business should have been going on for some time, for a tax liability to arise. Now, again, if you go to the definition of permanent establishment under the Nigerian Tax Act, those descriptions habitually, regularly, they have been dropped, meaning that, those considerations may no longer be relevant. But I think that what is important is to note that under the new regime, any non-resident company that carries on a business in Nigeria, that maintains a stock of goods or merchandise in Nigeria, that carries on business through an authorized agent, all those activities will qualify the profits of that non-resident for taxation in Nigeria. The last point I will make on this, and I alluded to it when I spoke the first time, is that it is no longer, I don't think it's appropriate now to try to split turnkey projects in such a way that an aspect of the project is carried on wholly outside Nigeria, so that you can make the argument that the profits from that part of the project will not be liable to tax in Nigeria. And that's again because the definition of a permanent establishment under Section 17(9) of the NTA makes it clear that it would not matter if the project is split, it would not matter the number of people who are involved in the project. The totality of the income will be subject to tax in Nigeria.
Okay, thank you so much, Mr. Ikwuazom. Next, I'll be going to the question that is directed to Mr. Oyedele or the regulators. That said, on the question of the absence of a supremacy provision in the new law, can the regulator or Mr. Oyedele please confirm whether the omission is deliberate and prevent treaty provisions from overriding the laws? So, Mr. Oyedele, I was wondering if you can please answer that question.
Yeah, thank you. So yes, the decision we took was there was no point trying to reinstate something that is clearly stated in our constitution. So where we have constitutional provision, you don't need to say it, otherwise it adds no value. So there's no intention for Nigeria to disregard its international obligations. That's not what we intend. The intention is for treaty provisions to still override our local provision. There's already an ongoing process to renegotiate some of those treaties as we speak. So if the intention was to override treaty, nobody will bother renegotiating them. Just write your law and implement, which should be against international principles, and that will not put Nigeria in a good light. We want to be a country that respects the rule of law, that respects our obligation, and that carries out things in a decent and respectful manner. So yeah, so nothing to worry about really. So maybe what we'll do is in the guidelines and regulations for implementing these reforms, we can put those languages there just to give people the comfort that this is not a problem at all.
All right, thank you so much. That's very helpful. So I will now go to our regulators. Some questions have been asked that go directly to them. So there is one which says there is a 30 days pre-action notice provision in the NRS Act, and there is another provision requiring taxpayers to file their objections to imposed taxes within 30 days. How do we reconcile this? Dr. Obidairo or Ms. Dili, are you able to assist us with answering that question?
Actually don't have an answer to that question, so I'll defer to Hauwa if she has an answer to it.
Okay.
Okay, but let me try.
Okay.
Okay.
Chukwuka, I mean, I don't see conflict. I think that there is a process for filing objections before a tax assessment becomes final. And that's what the second 30 days references. I think Chukwuka will be in a better position to answer the.
Yeah, Simeon, I completely agree. It's not even new. Under the current regime, there's a requirement for pre-action notice when you're filing an action against the Federal Inland Revenue Service and some of its principal officers, but that is totally inapplicable to a challenge of a decision of the FIRS with respect to a tax assessment. So I don't see a conflict. If there's an assessment and you've objected to it, and the tax authority has issued a notice of refusal to amend, you have to file an appeal within 30 days. You don't have to wait for 30 days to do a pre-action notice before bringing an appeal.
All right. Thank you, sir. So we have one more question for you, Mr. Ikwuazom, if you're still here. Okay, Hauwa, go on, please.
Oh, okay. I just wanted to re-echo what was said. My understanding is that the 30 days is for the filing of an objection for notice of assessment, while the pre-action notice applies on the service, that is the tax authority itself. I think that's just the clarification I wanted to give. Thank you.
All right. Thank you so much, Ms. Dili. Thank you. I'm going back to you, Mr. Ikwuazom, with this question. It says, given the expanded definition of PE, that is permanent establishment under the 2025 Nigerian Tax Act, particularly with respect to dependent agents and digital presence, could you elaborate on the specific criteria the FIRS would apply to determine PE status for non-resident entities engaged in cross-border digital services? Additionally, how will attribution of profits to such PEs be computed in practice?
Okay, thank you very much. So what I omitted to say is that, under the current regime, what we had originally were the provisions of Section 13(2) of the Companies Income Tax Act that specified 4 instances in which the profits of a non-resident company will be taxed in Nigeria. There was an amendment to Section 13(2) that introduced the concept of significant economic presence. And the SEP was applied primarily to non-resident companies providing digital services into Nigeria and non-resident companies providing management, professional, technical, and consultancy services to Nigerians. Now, what the new tax regime has done is to expand, as it were, SEP in relation to services, right? Such that the services are no longer limited to just management, technical, consultancy services, but all kinds of services. But the new regime has retained the SEP as it relates to non-resident companies providing digital services into Nigeria. But the regime has said that the minister will make regulations for the implementation of the SEP in relation to those types of companies. So the short answer to the question is that non-resident companies providing digital services into Nigeria, to the extent that they meet the significant economic presence requirements that will be prescribed in regulations to be made by the minister, they will continue to be liable to tax in Nigeria.
All right, thank you so much, Mr. Ikwuazom. Next, I'll be going to you, Mr. Agbada. You had spoken to indirect transfer of assets. Now, there's a question here saying, with the introduction of the indirect transfer rules targeting disposal of Nigerian assets through offshore entities, could you clarify the documentation and reporting obligations imposed on non-resident sellers? Furthermore, how does the FRS intend to address potential challenges related to valuation methodologies and treaty relief claims in such indirect transfer scenarios? I see that part of this question is addressed to the FRS, so it would be really helpful if either of Dr. Obidairo or Ms. Dili could also come in after Agbada has attempted to answer it. Thank you.
Thank you, Emma. Okay, so the first point I need to note is that there are no separate rules, right, regarding compliance for indirect transfers. So the general rules on compliance by non-resident companies, including payment of tax, filing obligations for non-resident companies regarding income derived from Nigeria, will be applicable. I noticed the potential challenge that you alluded to with regards to valuation, and that may be that may create a bit of a challenge, because in that case you are not necessarily valuing the Nigerian asset alone, but you are also valuing the shares of the non-resident entity. But I want to believe that in the long run, regulations will be issued clarifying the procedure that should be adopted, requirements, disclosure requirements, compliance requirements, to clarify how some of this, to clarify how indirect transfer regime would be implemented. Now, with regards to treatment of treaty benefits, I would make 2 points. One is the fact that not all Nigeria's double taxation agreements provide for indirect transfers. And the way double taxation agreements work is that it's just assign taxing rights between the treaty parties, such that it would say to prescribe which country would have rights to tax a particular income, to what extent, under what circumstances, right? So for capital gains taxation, some of our double taxation agreements, for instance, the DTA between Nigeria and the UK, doesn't give Nigeria the right to tax gains derived by a non-resident person from the disposal of assets located outside of Nigeria. So in that case, the indirect transfer regime should not even be applicable. I guess that, as Mr. Oyedele mentioned, maybe those are some of the things that should form part of the renegotiation of our treaties. And of course, if the treaties are updated to give Nigeria a right to tax indirect transfers, right, then of course it will be applicable. But with respect to the double taxation treaties that have indirect transfer provisions, I think like the one between Nigeria and Singapore, I think even South Africa, right? It is not Nigeria that will be providing treaty relief. It is the country of residence of the recipient of the gain that will be providing treaty relief, whether by exemption or by way of credit, provided that Nigeria has the right to tax that gain under the relevant double taxation agreement. What Nigeria should be concerned with or is interested in is if the criteria for taxing that income are met both under the treaty and under domestic law. When tax has been suffered on that income, the non-resident can then claim a relief from the tax authorities of of our home country.
All right. Thank you so much, Agbada. And I would like to again thank all our panelists. It has been quite a very educative session, and I trust that all the attendees found something useful to take home from this session. Unfortunately, we can't go on. We've exhausted most of our questions in the chat bot. And at this point, I'll just call on...
I'm sorry, Emma. I
Yeah.
saw a question. Someone asked how they can claim the CPD point for this webinar. Do you have an answer to that?
Not quite. There's someone who is supposed to be monitoring this from the MBA, and they should have already sent us. They should either put it in the chat bot, or we would have to send that to all the registered participants with respect to the CPD points.
Okay.
But I see that it is not in the chat bot. What we'll do is that we would have to circulate the link to all the participants so that they can claim their CPD points. Thank you for pointing that out. And so that you don't go, I'll just call on you to give closing remarks before we wrap up. Thank you so much, sir.
Okay. So thank you everyone for joining the webinar. On behalf of the partners of the firm, I would like to thank in particular Mr. Taiwo Oyedele. We understand how busy you are, Mr. Oyedele. And when I reached out to you, you did tell me that you'll be traveling about this time. You know, we do not take the sacrifice that you made to be part of this panel for granted. Thank you very much. I would also like to thank Dr. Obidairo and Ms. Dili for making our time to join us. Thank you very much for the great insights that you brought to the conversation, at least from the standpoint of the regulator. We don't take your participation for granted at all. And to everyone who signed up to be part of this webinar, clients of the firm, potential clients, colleagues, everyone who's made our time to join us, we say a very big thank you. So thank you to everyone, and bye.
All right, thank you so much. Bye, everyone.